In today's interest rate markets, I want to focus on the 10-year note, a big mover today. We saw some selling pressure. Certainly at the longer end of the curve is where the pronounced selling pressure was initiated today. Again, the dynamics within the marketplace, I think you got to point at the trade situation that really was the driver today. We had a positive tone all day long. It does appear that there has been some resolution. To what degree, the market's still not quite sure, but all the aspects and the way that the market's reacting are that they've come to some type of agreement here. And with that, the expectations are that they're going to roll back some September tariffs, possibly basically no further initiation with the December tariffs, and the phase one deal is for the most part done. And so hopefully we'll get some clarity on that in the next 24 hours, but the market is anticipating that that is the current situation. Interesting to see that we did see a PPI number this morning that was a little bit lower than expected, but ultimately I think now that the market's got this trade situation in its sights as being a done deal, that the market's now looking in a more forward-looking type of mindset, and that's why I think you're seeing the equity markets rally to basically new highs for the year, and the bond market coming under significant selling pressure. And let's look at the yields here as we move through the different durations. We're looking at a 10-year right around the 1.90. So again, not quite up to where we saw in the early November of that 1.947 level, but again at the upper end of the range as we're seeing the bond market adjusting for some of the dynamics within the space now that we're seeing some of these issues possibly being resolved. And when you look at the 2-year, 10-year spread, that widened out to 22.5 basis points today, so we continue to see that widening. And I want to point out that when you look at the term structure or the curve, the yield curve, it's normalizing after it being very disrupted earlier in the year because of the uncertainty with the trade situation and the Fed. Now the Fed's made their message a little more clear. Maybe we're getting some more clarity on the markets. And with that, we're seeing the yield curve going back to a more normalized situation. And when you look at the 3-month to 1 year, it's pretty flat right there. But then outside of the 1 year, you start to see a nice incline there, and you're seeing the markets now adjusting for the current dynamics and feeling somewhat comfortable at this point with the current pricing structure within the market when you look at the equity markets, and also you're seeing the bond markets adjusting for the dynamics moving into 2020.